Buying a home is a huge decision, and one of the biggest choices is deciding between a 15-year mortgage and a 30-year mortgage. With a 15-year mortgage, you own your home in half the time, and you'll pay a lot less in interest, but a 30-year mortgage may actually be the better choice. I'll show you why coming up next. For many families, deciding between a 30-year mortgage and a 15-year mortgage is a simple one. A 30-year mortgage has a lower monthly payment. With real estate prices hitting historic highs across the country, the decision is often more about engineering the most affordable monthly payment rather than making the best financial decision. After all, buying a home versus renting is one of the best financial decisions you can make. For those who are not trying to minimize their monthly payments, though, the decision to take out a 15-year mortgage versus a 30-year mortgage is not as clear-cut. When deciding which is the best mortgage for your family, a 15-year mortgage has several advantages. First, of course, is the fact that it only takes 15 years to pay off the bank. If your goal is to own your home outright, would you like to make monthly payments for the next 15 years or for the next 30 years for the same asset? Shorter-term mortgages also come with lower interest rates. In late 2018, you can get a 15-year mortgage with an interest rate of 4%. The going rate for a 30-year mortgage is 4.5%. A 15-year mortgage also costs less overall. Take a look at a $250,000 loan amount. A 15-year loan at 4% will cost $1,849 a month for a total payment of just over $332,000. A 30-year loan at 4.5% will cost $1,267 for a total of just over $456,000. Although your monthly payments are higher on a 15-year mortgage, you end up paying $123,000 less to own the same property. Assuming you can afford the higher monthly payment, it appears that a 15-year mortgage is a better deal, but it's not that simple. There are two reasons why a 30-year mortgage may be a better idea for most homebuyers. One of the most basic concepts in finance is the idea of time value of money. Money today is worth more than money tomorrow. Ask yourself, if you owe someone $100, would you like to pay them now, or would you like to pay them 1 year from now? In finance, the answer is you always pay later if you can. Why? You could invest the money in the next year and make it grow, let's say to $110, and keep the $10 for yourself. So how do we apply this to the concept of a mortgage? The difference between a $1,267 a month payment and a $1,849 a month payment is $583 a month. What would happen if you went with a 30-year mortgage, but invested the difference every year for the first 15 years? $583 a month is $6,990 a year. Invested at a conservative 6%, you would end up with just over $172,000 in savings at the end of the 15 years. The remaining balance on your 30-year mortgage would be about $165,000. You could completely pay off your mortgage and have almost $7,000 left over. An even better strategy, though, would be to continue investing, drawing the final 15 years of mortgage payments from your investment account. At the end of the 30th year, you would be left with over $38,000. So is there a catch? Yes. Most obviously, there is no guarantee you will make the 6% consistently over time. Yes, you could easily end up making more, but you could also make a lot less. Additionally, these calculations ignore taxes. Your investments are likely to be taxable, cutting into your rate of return, but the interest on your mortgage is also deductible, so there are both advantages and disadvantages to taking into account the tax side of things. The second benefit to choosing a 30-year mortgage over a 15 for most families is even more important. It gives you greater financial flexibility. By committing to a lower monthly payment on a 30-year mortgage, you're giving yourself protection against the possibility of things like job loss, illness, death in the family, or other life-changing event that could have a negative impact on your family. Here's my suggestion. For those who can afford the higher payment of a 15-year mortgage, take out the 30-year mortgage anyway. If you don't want to invest the $583 difference, simply add it to your payment as an extra principal payment. Most mortgages allow this and make it very easy to do. You'll end up paying down your mortgage in 15 years anyway, but you'll have the added flexibility of lowering your payment in months where money is tight. Whether you're choosing to invest the difference or provide your family greater financial flexibility, a 30-year mortgage may be a better choice. For more financial insights, please subscribe to my channel. I'll be releasing new videos every week covering financial planning, investing, insurance, and taxes. Or you can visit my blog at smartzonefinance.com for articles and infographics on some of life's most important financial questions. If you have a specific financial question you would like to see answered in an animated video, feel free to leave a comment below.